Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Tariff Man is back, Sonu. This is episode 121 of Carson's Facts versus Feelings. Who knows by the time people listen to this what the true drama with the tariffs will be. Yesterday, we recorded this Tuesday morning. Obviously, Monday morning, a lot of worry. Not as much worry now, but that could change a lot before we get there. Just you were talking about it, Sonu. Just imagine for a second, everybody. President Trump wearing a Superman outfit with a big T on him with a cape, flying around. Tariff Man. Isn't that just... Yeah. There you go.
And right now, maybe he's kicking a can down the road, too.
True. Mm-hmm. Yes, we're going to get into all that stuff. So we're going to really dive into, thanks everyone for joining the latest Facts versus Feelings. We're going to dive into the latest with the tariffs, what we know, some of what we don't know. There is a lot of uncertainty out there, and then get into the stock market and economy and all the stuff. We'll go like 40 minutes, then we'll be quiet. But Son, I think the most important thing, first off, do you know?
Speaking of which, I do have something important I wanted to tell you.
Oh, I'm sure if it's as important as mine, the listeners.
Oh, you like this. You like this.
Okay, let's hear it.
It's your hometown thing. Wait, you're from Cincinnati, right? No, Cincinnati is your hometown, right?
I live there originally. Springfield, Ohio,
okay,
southwestern Ohio. So yeah.
This weekend, my wife's originally from Columbus, and she grew up there. So this weekend, we found out there's a Graders in Chicago. Yeah, I thought you'd like that. There's a Graders, and it's in Winnetka, up north, on the north, further north of here, Wilmette. You know what Winnetka is? The Graders that is sitting in the spot used to be a store which was in Home Alone. I don't know if you remember Home Alone, when Kevin walks into a store, buys a toothbrush and all that stuff. Yeah. That store went down, the Graders went up. It's like half a mile away from Kevin's house in Home Alone, so we went and saw the house as well. That's my first time I ever saw, Kevin's house from Home Alone. So all of that. I thought, I have to tell Ryan this. I mean, you didn't get a kick out of it. It's Graders too.
So just so the listeners know, Graders is a Cincinnati-based ice cream. We're popular for a handful of things. Graders is right up there. Pete Rose is up there. Reds, Bengals, but Graders is a famous. Since we're about imports and exports, famous export of Cincinnati. It's very good ice cream, and that's been there for a while. And you didn't know?
I had no idea. My wife didn't know. I mean, I was like, wow. You know what I get? I get a chocolate milkshake.
Oh yeah,
I'm not an ice cream guy.
No,
she was thrilled. So we will go with the kids again, and I was like, it's a piece of Ohio in Chicago. How about that?
Yeah, I know our buddy John. John is listening. John's fed us milkshakes of Graders before, live on stage in front of people, John. So that's hard to focus when you're doing that. But that's good. So let's get into what really matters. And I'm sure there's disclaimers somewhere about what I'm about to say. Don't ever invest in this. Let's just have that. We have the Chiefs versus who is it, Sony? Do you know who the Chiefs are playing? I know. I didn't mean to set you up.
Wait. I'm going to embarrass myself, right? If it's not is it the Eagles?
Yes. Congratulations.
Oh, yes.
Good job.
Oh, all right.
Good job. All right. And
I honestly had to guess. I wasn't sure.
The quarterback's the guy who throws the ball. Just that's all you got to know. Then you're ready to go.
Please don't ask me about AFC, NFC, and all that.
Oh, yeah, I know. Yeah, you can talk trade policy all day, but not who's in the AFC. Anyway, we'll stop there. In 1910, a team from Philadelphia won the World Series, the Athletics. That led to the panic of 1910, 1911. 1911, Athletics won another World Series. 12 months of recession in 1911. 1913, the Athletics, a Philadelphia-based team, won a World Series. World War I was right around the corner. 1929, they won the World Series again. I think most of us remember 1929. 1930 was the start of the Great Depression when they won a World Series. And you got to go all the way to 1980. The Phillies won another World Series. You know what happened? Double dip recession. Terrible start to that decade. Then you had a long break until Philadelphia won either a World Series or a Super Bowl. 2008, the Phillies won a World Series. And are you ready for this? In 2018, the Eagles won a Super Bowl. 2018, stocks were down at one of their worst years of last decade, one of their worst years since 2008, which brings us to now We have the Chiefs versus the Eagles. I can't stand either of those two teams. So I don't know if I cannot stand Patrick Mahomes, all his ref buddies, hand him the game every single week. Buffalo, I'm so sorry what you went through, but believe me, as a Bengal fan, we've seen that time and time again.
You guys are a Taylor Swift family.
Yeah, I don't know
right?
if I'm maybe okay with like another financial crisis just so that guy doesn't hold another trophy. So I guess I'm saying Eagles, but it's a fun, playful way of saying if the Eagles win, that history would say beware. But also history would say never ever invest in this stuff. So anyway, Sonu,
and just to be clear, we're not hoping for a financial crisis.
No, I'm just hoping the refs call an even game, which means the Chiefs won't win because they're not the best team. They get it handed to them every single week. I'll get off my soapbox now. Anyway, Sonu, want to talk about tariffs? What's the latest? I mean,
I don't want to talk about tariffs. No,
I know.
Talk about tariffs.
I know. Yeah.
Maybe you should recap like what happened on.
Because I'm wondering. I haven't looked for 2 hours. I'm wondering the latest. So yeah.
So weekend we get Tariffs Man's back. 25% tariffs in Canada. Now, interestingly, like when several people in the Trump administration have said, "Oh, this is not going to have an impact on prices," but obviously they know this will have an impact on prices, and that's why what's Canada's largest export to the United States? Energy.
I thought it was maple syrup, but I wasn't sure.
Yeah. Okay. So maybe we have enough of that. But, we have enough lumber. But anyway, energy imports are going to be tariffed at 10%. So I think there's some acknowledgement that, there could be pain here if we put everything, a blanket 25% tariffs on everything, including energy. But also 25% tariffs on Mexico, 10% tariffs in China. And that was like, wait a minute, I thought China was a problem here as opposed to Mexico and Canada. But anyway, it is what it is. These tariffs apply to all goods over and above existing tariffs, right? That's what they said. The White House placed some conditionality on these tariffs. I mean, I'm with Neil Dutta on this, a friend from RenMac. He was like, look, President Trump has wanted tariffs all the way back from the 80s when, the Japanese were sending in their cars.
I think he was on with Oprah. Literally, there's like an Oprah interview where he's talking about this stuff. So this is nothing new.
This is core for him, right? Tariffs is what he wants. And we got tariffs. Now, like I said, they put some conditionality, like an improvement in the immigration situation, improvement in the fentanyl situation, which is not to say that, these are problems. These are big problems too, right? But there weren't any real specific goals and objectives beyond we need these things to improve, right? Look, ultimately, if the tariffs were going to be imposed, I mean, we would need to see implementation details, things like that. There were also provisions to ratchet up the tariffs if Canada, Mexico, and China retaliate. But what happened yesterday, or Monday, President Trump had a call with Claudia Sheinbaum, the head of President of Mexico. They came to a deal. I'll just put it in quote unquote deal, whatever it is. Market's happy. The peso went back up, and tariffs on Mexico postponed for 30 days. It took more than one call with Prime Minister Trudeau, which tells you who's easier to get to the negotiating table than not. So it took 2 calls with Prime Minister Trudeau, and finally by after the afternoon call, it's funny. I think reporters asked President Trump how did the call go? He's like, just watch, right? Trudeau was immediately in front saying okay, we've solved this problem. And, they gave some. They were planning to put 10,000. Spend. I think it's $700 billion US dollars on border security anyway. So that's going to continue to happen. They're going to put a fentanyl czar.
Fentanyl czar. Yes.
Fentanyl czar.
Which I don't know if that sounds good to be on your resume, but I guess.
I was the fentanyl czar. What is that? Is that a good thing? List cartels as terrorists, ensure 24/7 eyes on the border. It's kind of surprising that it's not already there. But then you think about, how long that border is, right? And then a joint U.S.-Canada strike force to combat organized crime, fentanyl, and money laundering. And here's the thing, right? Both countries are going to work with the U.S. to come up with an economic and security deal. Security deal, I think, yes, there are metrics, but even there, how do they measure that something's actually been achieved, right? And even on the trade side, yes, trade, you can technically measure, okay, how many imports. You tell Canada, hey, guys, you guys need to buy more stuff from us, period. Mexico, you all need to buy more stuff from us. We don't care how you do it. You need to do it. Guess what? We did that with the Chinese. And this gets to the China part of it, right? We did that with the Chinese in 2020. Remember, after the 2018, 2019 trade war, we got into a negotiation with the Chinese by January of 2020. This is just before COVID, I think it already hit China by then. Yeah, it had hit China by then. It came up with this phase 1 trade deal. China didn't meet any of those agreements. They were supposed to buy 200 billion more goods from the US, semiconductor chips, airplanes, all sorts of things. They met maybe 40-50% of that.
Sonu, I'm shocked. I cannot believe you're telling me that China had a deal and they didn't come through on it.
So there you go, right? No offense to the Chinese, but still, it just tells you it's not easy getting a deal, right? You can push the can down the road, and I think that's all that's happened, right? The can has been pushed down the road. Ultimately, look, here's some perspective. This isn't over, right? Compare where we are today relative to not where we were on Sunday night, but relative to where we were on Friday night, right? What do we have? The prospect of 25% tariffs in Canada and Mexico in 30 days, maybe 29 days now. 10% across the board tariffs on Chinese imports, which started at midnight last night.
China's retaliated.
Yeah, they've retaliated. It's kind of small bore stuff. I mean, again, I'm not saying 10% tariffs on coal and gas and other goods is not a big deal. I mean, for those companies exporting that stuff, yes, it is a big deal, right? But otherwise, from the aggregate US economy perspective, that's not a big deal. So I was like, wait, what's China trying to do here? I think China's probably holding back more retaliation. Okay, this tells me that they want to negotiate, but this is why it's going to be tricky. What sort of deal are we going to come up with, or we as in the US is going to come up with the Chinese that make sure that they actually implement their end of the deal? Good luck with that. That's all I can say.
I think good luck is probably the way to go. If you look at the United States, Mexico, and Canada, there's a total of $1.8 trillion of trade between those three countries every year. Mexico exports 83% of all their stuff. The United States, Canada, 77% the U.S.
This is why Mexico came back to the table a little faster than Canada.
Very quick. And the U.S. is 30% to those two countries. Total exports, and I've seen some different numbers, but this is pretty close. Mexico exports per year, $475 billion. Canada, $418 billion. And U.S., about $700 billion combined to those two. Now, here's the big one, Sonu, the size of the economies. Mexico's economy is $1.8 trillion. Canada's $2.3 trillion. And the U.S. economy is nearly $30 trillion. So the reality is, why did Mexico and Canada come back sooner? Maybe they are more of our partners, more of our friends versus China. But China doesn't export as much to the U.S. as they did because times have changed. So that's why I think you said this is going to hurt Canada and Mexico more, and why China maybe is on the other side of this saying, okay, you want to play this game, we'll up your tariffs. Is that kind of where we are with it?
Yeah. And with China, we'll come back to the Canada and Mexico bit because I want to talk about oil as well, right? And how big of a role Canada plays. Okay. But let's stay on the topic of China because that is going to be the crux of it. By the way, Tariff man hasn't put tariffs on Europe yet. That's coming, right? That's coming, right? There's going to be big tariffs on Europe coming because he is not happy with the Europeans. And the Europeans are sort of they don't just pick up, for good or worse, right? They don't just pick up the phone and say, oh, let's make a deal, right? They have so many processes and you have to go through Brussels and you have to go through the WTO. It's a pain dealing with the Europeans, right? So which is why any deal with the Europeans is going to be a mess because I think Trump and his team is probably just pick up the phone and talk to us, please. And these guys are, no, we need to have a body of 100 people negotiating every single piece of this, right? Yeah. So you can imagine the disconnect there. But anyway, sidetrack. It's all about trade anyway. But China, right? China, I think, would be interesting. How do they retaliate? I think first thing I'm watching this week is mainland China's been off Lunar New Year, all that. When they come back, I think tomorrow, Wednesday, when they come back.
Which, by the way, Year of the Snake. I think we talked about it last week. Yes. Really not all that great for equity markets. Here we go with a lot of volatility. So, of course, that's totally random. But last time we had Year of the Snake was 2013. Stocks are just fine.
There you go.
But sometimes Year of the Snake out of the 12 lunar cycles or lunar, not lunar cycles, what are they called? Lunar, I don't know.
I don't know.
The 12 Symbols.
I'm zodiac signs.
Zodiac sign. The word I'm looking for is signs. It is the worst return. So there you go. Year of the snake. Right. But go ahead, Sonu. I jumped in.
Which is not to say we are bearish.
No, we're not.
After all this, we'll talk about markets for this.
Exactly.
Right? But I guess we should qualify that. All this, everything we're going to talk about, that really hasn't changed our views, right? Mm-hmm. But going back to China, something I'm watching this week is how do they retaliate in terms of the currency? Unlike the Mexican peso and the Canadian dollar, they don't trade on open markets. The Chinese central bank controls their currency. So they put a particular level. They say, oh, you know what? The Chinese yuan should be $7.17, 7.17 units against the $1 US, right? 7.17 yuan against the US dollar. I'm curious, do they come on Wednesday, the Chinese central bank, do they put it at 7.2? Back in 2018, that's part of what they kind of did.
Right.
Overall, I'm not saying this was entirely them. Other things obviously happened in capital markets. But the Chinese yuan depreciated 14% against the US dollar in 2018, 2019. 14%. Okay. That is a big move for two of the largest economies in the world, right? So what happened? Their stuff became 14% cheaper. Now, we had tariffs on a lot of Chinese goods. Here's the other thing, and we wrote about this in our outlook. The other thing China did was, okay, fine, you put the tariffs on that, but we're going to put the factories, they're going to ship everything to Cambodia, Vietnam, Philippines, etc. Right? I think in our outlook, we wrote about Christmas trees. Yes. We used to get Christmas tree lights, not Christmas tree lights.
Lights. Mm-hmm.
Right? We used to get 80-85% of our lights from China. Mm-hmm. And this was before 2020. Fast forward to 2021, now 90% of the lights come from Cambodia. Do you really think Cambodia suddenly got a Christmas tree light making industry? No, it's coming from China, right? So the Trump administration did something, I think, smart. I said, you know what? Actually, they haven't done it yet, but this is, I think, from their perspective, would be smart to do. I'm not saying it'll be good for the economy. They talked about putting universal tariffs across the board on everybody. So you can't fudge around. Right? You can't go to Cambodia, you can't go to Vietnam because it is tariffs across the board on everyone, right? The other thing is that a lot of Chinese companies used to break up their products into smaller packages. And if the package is worth less than $700, $800, it wasn't subject to the tariffs, right? So it's something called a de minimis exemption. What the new tariffs, which were announced on Saturday and went into implementation, at least on China last night, midnight, that de minimis exemption is taken off. So everything is going to be tariff, right? But that's also, I feel like it's going to put even more pressure and work on U.S. customs. And say these tariffs had gone forth on Canada, right? If somebody from Canada sends you, a gift bag from Toronto to Cincinnati, sends you a gift bag, let's say it's worth $50. That would be subject to 25% tariffs. I mean, they have to open it, look at the value, things like that, right? It causes more work I think Trump's talked about, he's wanted an external customs force or something like that, like the opposite of the Internal Revenue Service. But anyway, this story isn't over yet. I think you and I are going to be talking about this for 3 years.
I can't wait. That sounds great. Yogi Berra said it's deja vu all over again. It's funny because a week ago on this very podcast, we were talking about AI and DeepSeek and all the trouble. Now here we are, we're worried about something else. But listen, yesterday on Monday, well, first off, you think about Monday night. I mean, there was a lot of panic. People looked right when futures opened Sunday night. Everything was selling off. They come in Monday morning, futures are still down like 2%, so a pretty good size drop. Finish off those lows again with the news that Mexico and Canada were getting some extensions on that. But still, I like to look at what the credit markets are doing. Like junk bonds on Monday were barely down. Junk bonds on Tuesday morning, the time we're recording this, are now higher than they were at the start of the week. I mean, all this stuff is out there. There's a lot of uncertainty. I know the media just love to dive into all this stuff and make it sound like a big deal. And we're not minimizing it, but it's like, did we just have the shortest trade war ever? I mean, Trump got some guys on the border and got some stuff, and I don't know. I mean, the China thing's not done, but it's just we can follow these things. We'll talk more about the stock market, but those are some things I think that are important. So, and I did see two different numbers, and Interesting. Bloomberg said the average tariff, if, again, we had the 25%, 25%, 10%, the average tariff in the U.S. would have gone to 10.7% from 3%. U.S. GDP would drop to 1.2%. JP Morgan said the effective tariff rate, if all that stuff happened, would jump up to 2.3%, which is a good deal higher as well. I mean, nobody wants tariffs. No one likes tariffs. Well, I guess President Trump likes them. But, we've had tariffs in our country for as long as you had a country. We've had a lot of tariffs since 2018. We've been talking about tariffs a lot with President Trump. So, yes, Sunday night it shook up things a little bit, but, I think so much of this is still art of the deal, and I just don't. I don't know. Color me skeptical. I'm following what the credit markets are telling me. Credit markets saying they're not too worried about a structural big problem coming yet. They will warn us. We're not seeing that. What do you want to add there, Sonu?
I think, look, with the impact on the economy and especially inflation, right? It's very hard to measure this stuff because first of all, we don't know what tariffs are going to happen and when. And what the rate is going to be. So it's all speculation.
I guess if the Eagles win, maybe we're in trouble. Maybe we'll just leave it at that. Yeah.
But then you don't want the Chiefs to win. Anyway.
Then I'm just miserable. So I don't know what to do.
Like,
I am torn on this whole Super Bowl thing. I don't know. Yeah.
And how it relates to the economy and markets. But look, so much is uncertain. We don't know what retaliatory measures are going to be. We don't know how the currencies are going to change. We don't know how people may shift their demand. Do they buy fewer Christmas tree lights? I mean, I don't know. And supply dynamics too, right? So what happens to supply chains that stretch across Mexico, Canada, and the US, assuming we do get tariffs on Canada and Mexico? Maybe we don't. But again, it's like the cloud hasn't lifted. Like I said, compared to where we were on Saturday night, Sunday night, we're in a much better place. Compared to where we were on Friday, there's a lot more. Suddenly, like I said, tariff man is back, right? And then the other thing is, I think a lot of people think prices didn't go up in 2018, which is true. Remember, in 2018, we were in a very disinflationary. I don't want to say deflationary. Right. The economy is good. Disinflationary environment. But if you just look at the components on which tariffs were implemented, right? Things like furniture, bedding, auto parts, motorcycles, sport vehicles, housekeeping supplies, stuff like that. Prices went up for all of them. But then for everything else, prices are coming down. So that offset that inflationary impact, right? And this time, right now, core PCE inflation, the Fed's preferred metric, is sitting at 2.8% year over year. You and I have talked about...
Just got that last week, right? Just got
that
data.
Yeah. You and I have talked about how we are going to, that's being pushed higher by these lagging things like shelter, maybe even financial services, like stock prices. That's also included in the PCE index. But we've been positive about that coming back to 2%. Interestingly, the Fed is also very positive about that. Last week, Powell talked about how the inflation setup is really good, right? Inflation's likely to come down over the next several months, right? So he was very positive about that, and which begs the question then last week, I wrote about this, like, wait a minute, then why can't you cut rates? You still think rates, policy is meaningfully restrictive. You're saying, we don't want the unemployment rate to go much higher, and we don't want the labor market to cool further. We think, inflation's set up to go down. Why not cut rates then? Well, they answered in December. They didn't answer it explicitly, but it was in the dot plot. They were worried about inflation uncertainty, right? And in high upside inflation risk. All of them switched to 15 out of 19 members switched from September to December, saying there's a lot more inflation risk now.
Right.
But when
wonder what happened in November.
I know exactly. And then they didn't. People at the press conference back in December, they asked Powell, why did you shift? And he was trying to dance around it, there's who knows, whatever. Everyone knew, right? Last week at the Fed meeting, he was just explicit. He just said, look, there's much more inflation uncertainty because of policy shifts, significant policy shifts, tariffs, regulatory stuff, fiscal policy, maybe deficits, things like that, right? That is why. So here's the thing, forget estimating how much inflation and stuff there will be, because we have no idea. We don't know what the impact on the economy is. So is it 0.5%? Is it 0.7%? Is that a nominal GDP? Is that a real GDP, right? If nominal GDP is growing 5%, if there's a 0.7% hit, that's 4.3. I think we can live with that, right? That's 4.3% is above the 2010, 2019 average. That's still good for corporate profits, things like that. But I think the Fed is the real thing. Watch the Fed. The Fed has said We are not cutting. We are pausing on rate cuts because there's more inflation uncertainty, right? And right now, markets are saying, maybe the first cut is not going to come until May or maybe June. Yeah. I think the danger here with these, even tariffs getting pushed out, is that suddenly the Fed is like, you know what? We're not ready to cut even in June. Mm-hmm. It may go to September. And what if they say we're not ready to cut at all in 2025? I think then we have a problem.
Yeah.
But that's yet to come. And we saw a taste of this, right? I was, I'll put this in my blog today. Last night I sent it out in a daily note. I was looking at the probability of no cut as Fed funds futures price it, right? And tracking that over the last 3 months. Between the post-election period, November 5th, all the way to December 6th, the markets gained 5%. The probability of no cut in 2025 fell to 4%. So markets are pretty much sure, like, we're going to get cuts in 2025. Between December 6th and January 10th, markets pulled back about 4%. You remember that? The probability of no cuts in 2025 went from 4% to above 30%. That was not even the base case. The base case is still markets expecting cuts, but there was a 30% chance that we don't get any rate cuts, right? And the markets pulled back. Then over the last month, less than a month, 3 weeks, that probability fell from 30% back down below 10%. Markets rallied. Now, yesterday, that probability started to tick up again.
Sure.
It's around 12, 13, 14%. I think that's the one we watch. Forget, is it going to have an impact on inflation, economy? Who knows, right? We don't even know what tariffs are. The key is, does this push the Fed out in terms of rate cuts?
Yeah. Well, that's why we're going to keep following it.
Okay,
Nobody knows,
keep watching.
But it's important. Thanks so much for turning into our latest episode. We'd love to hear your thoughts. Drop us a comment or let us know what you think. Your feedback helps us keep making our show better. Facts versus VS Feelings at carsongroup.com. And then also, please be sure to rate our podcast. It goes a long way. And wherever you're listening, Apple, YouTube, wherever, give a rating or thumbs up. It really helps with those algorithms that are out there. I don't know. I think we hammered home trade pretty good.
Yes.
I mean, let's move forward here. So we had a strong January for the equity market, Sonu. Year to date, before Monday morning when everything went crazy. So let's say year to date as of last Friday. The only sector down on the year was technology. 10 other sectors were higher on the year. Maybe surprising.
Hard to believe after, like,
hard to believe,
the Mag 7 and all of that.
Yeah, I mean,
right?
It's like, well, maybe the bar's a little high, but there's a long way to go, but interesting. But Sonu, when you have a positive January, this is called the January barometer, the rest of the year, so the final 11 months are up about 12% on average, higher, you ready for this? 87% of the time. So the next 11 months are higher 87% of the time when you're up in January. When you have a 2% January, like we just did, a more than 2% gain. Once again, you're looking at like a median of over 13% return in the next 11 months and higher about 84% of the time. When you're down in January, the next 11 months are up only 2%, higher about 60% of the time. So yes, this is just one data piece, but I'll tell you, when you think about so goes January goes the year, is the old saying, I would just stack this on top of a potential bullish driver for what's going on out there. And again, we have some breadth in the month of January. Small caps, mid caps did better than a lot of large caps did. No one's talking about that. And I know initially on the tariff stuff, small caps and mid caps lagged a little bit, but overall, we still see broadening out. We still see some very strong earnings. Let's keep it simple. More than 80% of companies are beating earnings. Looking at record S&P 500 earnings, strong profit margins. Corporate America's had pretty positive things overall. What to say? It's just all this tariff stuff. But in here, one more thing, Sonu. Welcome to February. If you look at February, it is like one of the worst months of last 2 decades since 1950. But in a post-election year, where we are right now, February is the worst month. Up like a coin flip, up only 1.3% on average. So that's the worst month. You got to ask yourself.
Thank God we have only 28 days.
Yeah, that's true. That's true. Yeah, we don't have leap day this year. The thing to ask yourself is wonder why. I mean, maybe it's just blear. It's just dreary February. Usually, though, you have the 3 best months: November, December, January. But let's think about an election. Kind of some optimism, some excitement, maybe markets do well, and then February comes, and maybe just maybe that new president or existing president, but still new term president. Maybe does some stuff that's not so popular. Just get all the bad stuff out early. Kind of sound familiar? Get all this tariff stuff and doing this now, causing volatility. I don't know if that's the way it works, but I think it very well could. Remember, last week we talked about the idea that post-election years, the last 40 years, the last 10 cycles, are the best year, right? Up like 19% average, higher 9 of the last 10 times. So maybe you have some indigestion, some choppiness in the first quarter of a post-election year. Would be perfectly normal after back-to-back 20% years. But the truth, again, I think, is the economy is still strong, the consumer is still strong. This is still a bull market. We'd still be pretty optimistic. And the fact January was higher, the first 5 days were higher, the first 5 days were higher. So I kind of mumbled that. There still are some positives on the overall structural bull market that we still think we are in, Sonu. What do you want to chime in and talk about there, Sonu? We got like 10 minutes probably.
I like that because let's connect it to our outlook and
thank you. Yeah, thank you very much.
Because you picked. I mean, it all gets to, yes, February is, historically weak. I think part of it, especially after an election period, the honeymoon's over, right?
Honeymoon's over. Well
now,
said.
Now you have to get into brass tacks. And guess who? A lot of those brass tacks have to do with Congress. Congress takes time, right? And this is the part I think it gets to our outlook. Nothing we've seen over the last 8 days, including all that deep seek stuff, has really changed our outlook. Yeah, like we talked about in the podcast last week, the deep seek stuff actually makes me more optimistic about that broadening story because now AI is cheaper. Okay. Everyone will spend even more. I don't know. Last week it was Javon's paradox. I mean, this time with trade, it's a trilemma. We'll have all sorts of things, right? But no, I think we have momentum going for us from January, right? The AI story, I think that lends itself to more broadening out because AI is cheaper. And tariffs, look. Tariffs, the thing is, if you told companies in America we're putting, forget 25%, 50% tariffs, they'd figure it out. Yeah. You know what? We have, it's the uncertainty that's a problem, right? And that gets to, I think for that, the focus should be on, how does this impact the Fed, right? But the other side, the counter to that, here's the thing, here's a stat, right? Over the last 2.5 years, since the Fed took rates from 0 to 5 and they've dropped it back to about 4.5 now.
Okay.
I remember everyone said there'll be a recession, all of that. Over the last 2.5 years. Yes. Yeah, you remember that.
Everyone.
You know
that. I recall.
Yeah, right. Over the last 2.5 years, real GDP has clocked at 2.9% annualized pace. Last 10 quarters, 2.9%. That's stronger than just 2017, 2019, which is fairly strong. It was about 2.8%. 2010 to 2019 was about 2.4%. 2.9% was not only above that trend, it just completely put paid to all those recession predictions.
Right.
We grew above trend. Then you think about why. A big part of it, and this was after stimulus and all of that, right? If anything, you thought, Fed rate cuts should hurt. And it did hurt. It did hurt housing a lot. Housing is a big drag. But what countered that? Two things. One is services spending. Services spending is well above trend. Right now, it's running about 3%. 3% annualized growth. Quarter over quarter. Before the pandemic, just for perspective, it was around 1.7, 1.8%. This services is 45% of the U.S. economy.
Right. Mm-hmm.
That's growing well above trend, more than 100 basis points above trend. So the economy has those strengths, which is what we talked about in the outlook. It's partly the labor market, right? Where is the other piece coming from? Part of it, government. Government spending, even in 2017, 2019, it was running pretty strong, about 2.5%. For the last 10 quarters, it ran about 3.5%. So that's where the other piece of, that's what's driving GDP growth higher. And that gets to what we talked about in our outlook about, yes, there are tariff threats. The Fed could be a risk as well. But what could counter that is tax policy and tax cuts by Congress. Now, normally, as you and I have, like what Sam Stovall said, the opposite of what
well, I was going to break that. Our good friend Sam over at CFRA says if the opposite of pro is con, then the opposite of progress must be Congress.
Thank you. There you go.
It's a good zinger. Thank you. Sam's full of them, so that was good.
That's great. And so with that in mind, normally you think, okay, do nothing Congress is not the worst thing, right? We have the numbers to show that a mixed Congress is not a bad thing. Problem is this year, if they don't do anything on January 1st, all our taxes go up, right? So they have to do something. For one thing, none of us want our taxes to go up. And second thing, I don't think any member of Congress wants to go into a midterm election year, let alone the president, want to go into a midterm election year having raised everybody's taxes. So they have to do something. But as part of that something, to just extend the tax cuts, just don't do anything else. it's going to cost about $3-4 trillion more for the deficit. Now, deficit, you can argue like, okay, that's going to scare the Fed even more and maybe keeps rates elevated. But deficit spending also contributes to profits. We're going to remember more money in people's pockets means more spending. And and we may get even more tax cuts. Maybe the corporate tax rate goes from 21 to 15. Maybe we get no taxes on Social Security, no taxes on tips. These are things President Trump talked about. I think all of that, as we wrote in the Outlook, more than counters any threat from tariffs, any risk from higher interest rates, right? I'm not saying everything's really a hunky-dory and there's no uncertainty. There's obviously going to be volatility like we saw on Monday, Sunday night. But I think the opportunities, especially fiscal policy from the tax side, I think long run, maybe, yes, I think it lends itself to keeping rates elevated. That's a hit for things like housing. But in the immediate term, we're talking about 2025, I think fiscal policy, tax policy, as long as Congress gets its act together, counters everything else.
That's a big if. So
yeah, I know.
Now again, we're kind of near the end, so I don't want to spend too much time. You've looked into this. Years with big deficits, usually the stock market and economy do okay, right? I mean, people think it's bad, but
more than okay.
More than
okay.
Strong. Right?
I know it's a bad thing to say. Everyone that's a bad thing to say.
That's why I'm tossing this in at the end. Everyone's gonna get mad at us for even talking about this. But hey, this is facts versus feelings. Your feelings are, I don't want to have big deficits. Nobody wants the government to have $37 trillion worth of debt. Nobody wants $1.1 trillion worth of credit card debt. But the facts are there's also a lot of equity and there's some stimulus that come from those deficits, right?
Yeah, and temporarily, it's sort of like, and we saw this in 2018, 2019. Deficit spending rose. Like if you just take the government's primary deficit, so excluding interest payments on debt, so just what the federal government is spending on.
You just made a bunch of people mad. You just made a bunch of people mad too. You have to include that, but I can't disagree, honestly. But anyway,
at the same time, right now, if you include that, it's even, I don't know, better or worse, how you think about it, because who's getting all that money, right? It's all of us.
This is second level thinking, as Howard Marks would say. You start to,
exclude that. In 2018, 2019, anyway, interest payments on debt weren't a lot, right? But that primary deficit, right, went from about 0.5% of GDP in 2016 all the way down to 2% of GDP. What does that mean? The government is taking in less revenues because that huge tax cut bill that passed in 2017, they started spending a lot more. We had several years of something called sequestration in 2012 to 2016 or so. 2017, Republicans come back into power. They take off sequestration. They spend more on defense, more on non-defense spending. All of that, I think, was sort of like a get-out-of-jail-free card for the trade war. Trade war, I think, at the margin hurt, and you can look at the investment data for that. But all this is the deficit spending overcame that. Could we see that again? I think that's the possibility. I think we are likely to see that once again. Mostly, look, if we didn't have a fiscal cliff on January 1st, 2026, I would say Congress is not going to do anything. And then we really have to worry about the trade war and uncertainty in investment and all of that. But because they actually have to do something, they have to write legislation so that all our taxes don't go up. I think we'd start to, get a little more deficit spending. Again, in the long run, ultimately more deficit spending, especially now. I think the Fed looks at that and says, you know what, we're going to keep rates higher for longer. But that's a problem for 2026, 2027.
Yeah, fiscal cliff had flashbacks to the second half of 2012. We literally heard that word or those words every single day for 6 months. And then it came and went on January 1st. In 2013, the last time we had a year of the snake, stocks gained almost 30%. So thanks to our friends at Ned Davis Research for helping update some numbers for me here. Reached out to Ed Clissold, the I believe chief strategist over there. Just let's remember, let's kind of end with this. Volatility is the toll we pay to invest. We like to say that around the Carson team. Every year on average, since 1928, Sonu, this is on average, has had 7 3% dips. It's had 3 5% mild corrections, 1 10% correction on average, and then about every 2 years, you get a 15%er, and about every 3.5 to 4 years, you get a 20% bear market. All right. So to think this year is not going to have a 5% mild pullback at some point, maybe not going to have a 10% correction. It might not, but we didn't have one last year. I think we probably have one this year. I think it's really important to put some context around this. Plans are useless, but planning is everything. I like to use that one. President Eisenhower. The thing that we're telling our more than 500 Carson partners in 42 states and their clients is this. Let's plan for some volatility. Let's plan for some scary headlines. Every single year has volatility and scary headlines. This year's not going to be any different.
And maybe more so this year relative
maybe
to us,
more
right?
so with this different things that are happening. Absolutely. 2 Sunday nights in a row, there was a lot of fear out there. 2 Monday mornings in a row. I don't know if panic's the right word, but I felt some panic from some people. We had a lot of people reaching out to us that were extremely worried about what was going on. Here we are 26 hours later, and S&P's, everything's green. Like, I mean, you know, it's like, okay, that was fast. So let's just kind of remember these things. And believe me, we're going to keep doing this podcast. We have so much fun doing it every single week. Whatever's in the news, we're going to talk about. But it's just really important, I think, to remember volatility is the toll we pay to invest. So, Sonu, I know we're about where we are. Well, yeah, I've said it once or twice, but it's important to remember it, even to remind ourselves sometimes with all this stuff. This, again, was episode 121. Carson's Facts versus Feelings. Ryan and Sonu here. Tariff Man is back. So hopefully you enjoyed this, Sonu. Thanks. Good discussion. You and I get to do it again in about an hour. So this is a good run through for what we're going to do with the live stream.
Practice makes perfect, right?
Well, I don't know. Practice makes something. I tell you what, practice makes me I'm hungry. I'm ready to go get some food in between this and our live stream. Ooh, a milkshake for the live stream. I didn't even think of that, Sonu. I didn't think of that. I don't think it's going to happen. I don't think I can pull it off. But anyway, all right, everybody. Thank you. We'll be back next week. Talk soon, Sonu. Thanks, everyone. Take care. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor,